Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Speaking of impact of higher rates, a recent data from the Federal Reserve shows that more Americans are being turned down for loans. This is the combined impact of interest rates and the general caution among the lenders. The rejection rate for loan applicants jumped to 21.8%, which is the highest in the last 5 years, and major rejections coming from applicants who have credit rating below 680. One more interesting narrative developing has been big names betting on Japan lifting the yield curve control. Good morning, JK. I'm very interested to know your take. Do you think the Japanese will lift the yield curve control?
Yes, Swaraj. I think the credit conditions tightening in the US is definitely a welcome news for the Fed, who is looking for lowering the demand and then addressing the inflation, high inflation. Although it has already started to show some moderation as per the CPI and the PPI data that has come last week. And as far as the Japanese yield curve control tweaking is concerned, there is no real clarity, at least from the official statements. So far, there have been mixed signals from them. But the market 10-year yield is really now trading very close to the cap of 0.5%. And so hence, there are some speculations that, there may be a move to lift the cap or increase the cap, because once it hits levels closer to 0.5, earlier we have seen that they come and buy up a large amount of JGBs and push the yields once again down. This time it has not happened, so that may be one possible indication. In the meantime, yields have in other countries haven't really moved much, having seen large moves last week in the wake of CPI data from the US, and also not so inspiring data from Europe. In fact, yesterday the yields did fall after not so inspiring data from China, where the GDP data both on year and the quarter on quarter disappointed. And Chinese central bank is really in a very tough situation, because country needs further easing in the credit conditions, but at the same time, is already a big concern about the kind of debt risks that they are carrying out, as well as the structural distortions that is there in the economy. So that's the reason why Chinese, even once again weakened yesterday. Chinese stock markets were down, and the yields in other countries also followed. Also, there was a report from the German central bank, the Bundesbank, which did not give, which gave a downbeat assessment of the economy for the coming year. They are seeing the economy shrinking by more than 0.3%, in the year ahead. Although there was a small bounce in the second quarter, so far they have been pointing out to demand from foreign customers reducing, higher cost of financing investments at home, and the decline in the business confidence. In fact, Germany is one of the largest manufacturing countries, and the current slowdown in China and a few other economies is actually leading to big hit to their growth as well. On the currency side, on the yield side, of course, some blip was there after the Empire State Manufacturing Index that actually beat the estimates, coming at 4.7 from minus 3.6. But this is a kind of minor data, and also is a volatile number, which the market does not value so much. Therefore, the yields came down after that. Generally, yields are trading a bit heavy as we move closer into the Fed meeting next week. We are already, entering the blackout period for the Fed members, speaking out, and the estimates show 97% probability that next move of 0.25% next week. But there's no real clarity, or rather, I would say very low minority is looking at any further hikes from US until we see more data on inflation and growth. We will have retail sales and industrial production today, which will be closely watched for how the economy is performing. As far as the stocks are concerned, unlike yields, they have been able to hold on the gains, at least in the US, because not only is the inflation down, but also economy has not given such a a negative picture as was being expected. Apart from that, there have been good corporate numbers so far. Big names like Tesla, Netflix, Bank of America, Goldman Sachs, and Morgan Stanley are going to announce their earnings in this week. But the focus will be on the regional banks. Because their deposits have been coming down, and so there may be some negative reaction going forward if these banks show a poor number, which is what is expected. On the forex side, yes, Chinese yuan once again weakened from 7.13 to 7.18 recently. Otherwise, dollar has been consolidating. Euro and GBP short-term overbought conditions, but they have been correcting more on that, in terms of time than in terms of price. 1.1250 on the euro and 1.31 on the GBP have been, not able to sustain gains beyond those levels. So we will continue to see more consolidation. Perhaps a small dip is par for the course as far as euro is concerned, because it does look quite overbought, and we are not getting any bullish news from the European side. As far as the Indian markets are concerned, the equity juggernaut is making steady gains, attracting almost 15 billion of inflows from FPIs in this calendar year. What is to be noted or slightly concerning for the rupee bulls is the inability of the currency to gain despite these flows and ignoring gains in other currencies. And what would be the outcome if FIs take a pause and the much needed correction in stock arises? Currently the gradual hedging by importers and exporters near term is par for the course. Breakout levels in INR have narrowed down to 81.90 and 82.25, and we will await the break to get any sort of excitement. Finally, speaking on the global inflation news about Russia suspending the so-called Black Sea Grain Initiative until its demands to get the Russian food and fertilizer into the world are met, insisting the decision had nothing to do with Ukraine drone attack on the Crimean Bridge. So the decision could have a significant impact on the food inflation, particularly for the developing nations. Wheat and corn futures have pushed higher overnight, but the move wasn't sustained, and the prices are down once again. But I think if the ban on the export continues, we could see some sustainable impact on the food prices overall. Overall, looking for a very quiet day until the US session, and then we await for the big decision from Fed next week. Thank you.
Thank you, JK. And the entire theme, rupee has been disappointing. I think both the rupee bulls and the rupee bears for the past few days in this consolidating markets, while Indian equities have been making steady gains and we have been getting steady FII inflows into the Indian equities. The upcoming data is, of course, retail sales from the US and industrial production data. This will be closely watched. Even though the Empire State Manufacturing Index from the US beat expectations, the data is quite volatile, so not much importance is given to that. That's it from us today. Thank you so much for listening. Tune in tomorrow for another round of fresh updates. Thank you.